Inflation remains a major issue for consumers, companies, politicians, and central bankers alike, and we get the latest batch of data from the UK, from the Office for National Statistics, on Wednesday, the 19th of October. By way of a reminder, the headline numbers last time around for the month of August were: the Consumer Price Index, or CPI, rose 9.9% year on year. That was a slight but welcome improvement from the 10.1% year-on-year increase in July. They are, however, the two highest individual figures on record for this dataset, which was introduced in 1997 and backdated to 1989. The Bank of England's preferred inflation measure, CPIH, which includes housing costs, rose 8.6% year-on-year. That was down a little again from 8.8% in July, but again, they're still the two highest readings on record for this dataset, which goes back to 2006. The Retail Price Index, or RPI, rose 12.3% year-on-year for the second month in a row. This is no longer an officially recognised statistic, but it has the longest history all the way back to 1948, and the last time RPI inflation reached such levels was March 1981, and 41 years ago, the Bank of England base rate was 12%, not 2.25% as it is today. Monetary policy is still very, very, very loose as measured by the real or post-inflation base rate and that's minus 10%. In fact, it's not been this loose since 1976 when inflation was absolutely rampant. So the Bank of England is still in a bit of a pickle. On one hand, it's trying to head off inflation by raising interest rates. On another, it doesn't want to overdo it and tip an indebted economy into recession. And on the other, it's keeping an eye on the pound, which remains near multi-decade lows against the dollar. It's also trying to keep an eye on financial markets, which are getting a bit choppy. Note, then, back in the 70s, it took a very, very, very long period of positive real interest rates to head off inflation. So either the Bank of England's got work to do, or it's going to be getting the prayer mat out, or both. On the corporate front, trading statements are generally the order of the day from a wide range of large, mid, and small cap firms. Names which may be worthy of further research include the following, although do note some of these dates could be subject to change near the time. Naked Wines on Monday, the 17th of October. Rio Tinto, BHP, and Bellway on the 18th. Antofagasta and Spectris on the 19th. Travis Perkins, Bunzl, Segro, Schroders, Dunelm, National Express, and Sentiment on the 20th. And London Stock Exchange and Intercontinental Hotels will round off the week on Friday, the 21st. But the stock which could just cause the biggest fuss in the week ahead is online fast fashion retailer ASOS. The FTSE 250 index member is scheduled to release its full year results for the 12 months to the end of August on Wednesday, the 19th of October. ASOS shares are, wait for it, down by more than 80% over the past 12 months, and that is despite the company's move from AIM to the main market in February and promotion to the FTSE 250 index in June. There can therefore be no better reminder of how it is the fundamentals of profits, cash flow, and valuation that matter over the long term, not piffle about what an index or stock is in or how index entry can spike near-term fund flows from index buyers. ASOS shares trade at their lowest level since early 2010, hampered by profit warnings last October and again in June and September of this year. The reasons given for those alerts have ranged from bad weather to freight shortages, rising shipping costs, product mix, and, most recently, increased product returns, input costs, and sagging consumer confidence in the face of increases in the cost of living. Profit warnings from retail rivals and peers such as Boohoo and Next have hardly helped sentiment either. New Chief Executive Officer Jose Antonio Ramos Calmonte therefore has his hands full, although shareholders will be hoping that he took the kitchen sink to forecasts when he delivered September's profit warning alongside a full-year sales update. Back then, the new CEO offered two headline downgraded forecasts. First, that full-year sales would come in at around 2% higher than a year ago on a constant currency basis, a figure that implies a flat fourth quarter. On a headline basis, analysts are looking for sales of £4 billion, up 2.5% from £3.9 billion a year ago. If the new boss only offers any guidance for fiscal 2023, then note that analysts are looking for 7% sales growth to £4.3 billion. Second, he forecasted adjusted pre-tax profit will come in at around £20 million compared to £194 million a year ago. That includes between £30 and £50 million of exceptional costs. So on a headline stated basis, analysts are looking for a £12 million pre-tax loss compared to a profit of £177 million a year ago. If Mr. Calamonte offers a forecast for fiscal 2023, analysts are looking for a rebound to a pre-tax profit of £65 million before exceptionals. Finally, everybody will be looking at the balance sheet. ASOS had £63 million of net debt at the end of the first half, a big drop from the year before, thanks mainly to the £265 million acquisition of the Topshop, Topman and Miss Selfridge brands from the former Arcadia Group, as well as higher inventories due to slower sales and increased capital investment. CapEx for the year is expected to have exceeded £200 million for the year just ended, as ASOS continue to spend on warehousing capacity in its platform. Analysts see a similar level of spending in fiscal 23 and fiscal 24. Hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.